Zepto, PhonePe, Oyo, Meesho, Car Dekho, Fabindia, Haldiram, Cultfit, and even Physics Wala. What do all these companies have in common? They are all lining up to launch their IPOs. And let's be honest, these IPOs are exciting. Why? Because we are familiar with these companies and have been using their services. That is why it is natural to participate in these IPOs. And what do most people are going to do? They are going to look at the GMP data so that if the stock is listing at the premium, they can book some listing day gains. And that, right there, my friend, is one of the 5 common mistakes that you make when you invest in an IPO. So let's talk about these mistakes. Not to scare you off, but to actually help you invest smarter. Talking about the first mistake. One of the biggest temptation to invest in IPOs is to make quick money via that listing gain. And hey, no judgment. Who doesn't want to buy a stock today and sell tomorrow for a 20% gain? But here's a reality check. That doesn't always happen. Let's look at some data. SEBI reported that 144 companies were listed between April 2021 to December 2023. Out of these, nearly 75% delivered positive listing day returns, meaning around 25% listed at a loss. That is a win-to-loss ratio of 3:1. Sounds good, right? Well, here's a catch. 11 out of those 144 companies gave blockbuster listing gains, like Zomato, Paras Defense, and more recently, Tata Technologies. Moreover, another 11 companies, they opened flat. Now, I think you must be expecting at least 10% gain on the listing day. But if we take out those outliers and flat performers, only 63 IPO gave more than 10% returns on listing day, and 59% gave less than 10% returns. Which means if we take out those outliers and flat performers, the number start to look more modest. Here's a quick snapshot of much talked about IPOs and how they performed on their listing day. Some IPOs like Tata Technologies and Zomato delivered massive listing day gains. But others like Paytm, Muthoot Microfin and Hyundai Motors disappointed investors right from day one. In fact, Paytm's IPO remains one of the most infamous examples of chasing hype that can lead to huge first day losses. So don't make this mistake. IPO is not about how it lists on the first day, rather it's about how it performs in the long term. By the way, a quick question. Do you know how Swiggy went about filing its IPO? Most people don't. I'll tell you that in the end of the video, because this is something very important that can affect you as an investor. Coming to mistake number 2, since most of the people invest in IPO for the listing day gain, which leads to the second mistake, that is not doing your homework. Let's be honest, do you not invest in IPO because your friend is investing, or you saw a post on Instagram which said, apply now, GMP is high? But IPO investing requires actual research. And the good part, it need not be very elaborate. You need to focus at some basic things. Let's talk about DRHP, Draft Red Herring Prospectus. I know a lot of people say, read DRHP. But let's face it, that thing is longer than your cousin's wedding guest list. So, here's a shortcut. If not all, let's look at these 5 things. Number 1 is before investing, you need to understand what the company does and what problem is it solving in the society. If the business is not scalable, then it's a red flag. Number 2 is to check the financials of the company, if there is consistent growth or not. Because if there are continuous losses, which means they need a strong turnaround plan. Number 3, you need to check if the company is coming up with an IPO for some kind of growth, or they are coming up to pay off their existing loans. Number 4, you need to check the risks of the company. What are their competitions, their dependence upon a particular product or a market, their existing debt, etc. If there are too many risks, again, a red flag. And number 5, is the company coming up with the fresh issue or offer for sale? Fresh issue means they are infusing new capital in the company, which is a good thing. But offer for sale means that existing investors are exiting from the company. And if most of the IPO is OFS, then you need to know why are the existing investors exiting. Coming to mistake number 3. This one's underrated but super important. Let's say metal company is launching an IPO when the commodity prices are booming. Margins are sky high. Everyone's excited, so you apply. But commodities are cyclical. Just like IT sector, which booms during digitalization cycle, FMCG shines during slowdown, which means sectors follow patterns. And most IPOs launch at the peak of their cycle to capitalize this hype. What happens next? The cycle turns, profits come down, stock prices crash, and the IPO that you invested in is down 40%. Let's take Shyam Metallics for an example. It went public in June 2021, right when steel prices were soaring due to post-COVID global demand and supply shortage. The IPO was a hit, oversubscribed 121 times and listed with 24% gains. But as the commodity cycle cooled in 2022, steel prices fell, profits came down, and the stock crashed 30%, and it took nearly 3 years for the stock to come back to its listing day price. Or look at the tech IPO wave of 2021-22. Companies like Zomato, Nykaa, Cartrade, Paytm, and Policy Bazaar. These IPO rode the digital transformation hype. Zomato and Nykaa saw massive listing pops, but within months, global liquidity tightened, digital ad spends dropped, and growth projections were cut. Stocks like Zomato took 3 years to return to their listing price. Nykaa still hasn't recovered even after nearly 4 years. Therefore, always ask, is the company's sector at a high point right now? If yes, then be cautious. Here is a quick cheat sheet that you can look at while investing in IPOs to keep in mind the cyclicality. Coming to mistake number 4, it's GMP. Grey market premium basically is an unofficial premium at which the IPO is being traded before listing. Let's assume the issue price is rupees 100 and GMP is 40. Therefore, people expect the IPO to list at rupees 140. Let's take a few real IPO examples. Tata Technologies IPO had a GMP of 475 before listing. The stock actually opened strong, proving the grey market's prediction right. In the case of Nykaa, it also had a GMP of 775 and the stock saw huge listing gains. But here's the truth. GMP is not a true indicator. Number 1, it is not regulated. And number 2, it is driven by demand, hype, and sometimes manipulation. Remember Hyundai IPO? Massive hype, positive GMP, and yet it listed negatively and fell further. Same with Cartrade. I think it's safe to say that GMP is not the guarantee to the listing gains. It's simply an indicator that tells you about the market sentiment. So don't let this GMP become your research report. If you want deeper intake on GMP, then do check out this video. Now coming to our mistake number 5. Be honest and tell me, do you invest in IPOs because of FOMO? Your friend applied in 3 IPOs and got 2 allotments and he made 15K in just 2 days? Or your neighbor who keeps talking about IPOs like it has become the new Bitcoin. And then you think you should also get into this IPO investing game because you don't want to be left out. Well, investing isn't a popularity contest. So if you are doing it because everyone else is, so take a pause. Because by doing this, you might invest in bad companies and that too at higher prices, which you will regret later. And to be honest, this regret hurts more than just missing out. Okay, so remember I asked how Swiggy go about filing for its IPO? Well, Swiggy used something called as confidential IPO. In case of a regular IPO, they file their DRHP with SEBI and also make it public upfront. But in case of confidential IPO, they file their papers quietly with SEBI and they make it public much later, just before when the IPO is about to open up. Sounds harmless, right? But here's why it matters to the retail investor, because now you get very little time to research. By the time the DRHP is public, the IPO is almost out, creating a lot of frenzy. So keep your radar up. Don't wait till the very last to research about your IPO. If you are serious, start reading that DRHP. Now let's quickly talk about the things that you need to remember before investing in an IPO. Just because a brand is popular doesn't mean the business is profitable. Number 2, IPO is an exit event for company's early investor, not an entry event for you. Number 3, always look at the company's fundamental, not just the hype. Number 4, compare with listed peer. If it's too expensive, skip it. And lastly, don't invest more than 5 to 10% of your portfolio in IPOs. Keep risk in check. IPOs are exciting, but they are certainly not a guaranteed win. Behind that hype could be risk, overvaluation, and FOMO. So invest with research and not emotion. And tell me in the comments which IPO are you going to research before you invest. See you in the next video. Till then, happy investing.